The principles of a good investment. If you have an idea or know a thing or two about investing, then you're probably aware of some of the following principles. But if you have no clue, no worries, we've got your back. We'll share with you 15 of the most important principles that will guide you in making investment decisions, which will keep your investing on point. These investing principles are in no particular order, but I believe the last few are the most important. But right before we begin, do me a huge favor and hit the like button. Also, if you're not subscribed to our channel, you're missing out big time. Tap the subscribe button and the bell notification icon so you don't miss out on any of our videos. Now, let's begin. 13. Risk and return go hand in hand. The ultimate principle of all investments is that risk and return are basically different sides of the same coin. You see, the higher the risk, the higher the rate of return. For example, an investment that promises you a return of over 20% of your initial investment will most likely have a higher risk compared to an investment that will give you a 10% return. Also, keep in mind that investments that substantially increase rapidly are very high risk. For example, let's say you invested in a stock that grew by 50% within a year, which is a very good return on your investment. Now understand that this is probably a very volatile stock, and as quick as it grew, it can come crashing down just as fast. We will talk more about this later in the video. Risk and return are like fire and oxygen. The safe investment, as we all know, offers the lowest return for your money, and most investors usually flock to these kinds of investments because nobody wants to lose their hard-earned money. However, for a risk taker hungry for huge returns, these safe investments aren't as appealing. They prefer riskier investments with potentially huge upsides, such as startups and IPOs. With this in mind, it's up to you to choose how to play your cards. 12. Diversification is paramount. One of the best ways to secure your money when investing and also guarantee a good return is to diversify your investment. We all know that stocks are like roller coasters, and they constantly fluctuate depending on market conditions and what's going on in the country. This is why gurus in the investing industry usually advise people to diversify their investment portfolio. This means you can invest in different asset classes, such as bonds, commodities, stocks in different sectors, such as tech, energy, healthcare, and so on. If you hate losing money, diversification is your best bet to safeguard your investment while at the same time growing your money. You see, by diversifying your portfolio, you're insuring your investments against constant market volatility that can easily wipe out your money. Let's say if 2 out of the 5 stocks in your investment portfolio are performing poorly, then the other 3 stocks should cover the losses of your 2 losing investments. This principle ensures that you lower the risks of your entire investment. 11. Regression to mean is a thing. This may sound a little confusing to some of you, but it's really not that complicated. It simply means that all the things in our world, from average return on investments, ROI, to average yearly rainfall, usually returns to its historical averages. Let's say a stock has been performing extremely well for the past 3 years, constantly giving investors an ROI of 28% or more annually, while the average return rate for similar stocks is 9%. While every investor dreams of a stock that will guarantee them year on year a return rate of 28% or more, just like in our example, this almost never happens. Most stocks, just like the one we mentioned before, will usually return to its industry average and historical yearly growth. So although the stock did grow at 28% or more each year for 3 years, it will most likely return to its industry average of 9%. When most investors are analyzing stocks, they look at the most recent returns of an asset class, rather than the past trends. By doing this, they are trying to foresee and predict its future performance, because the regression to mean concept will take place. Stocks that constantly overperform for a couple of years will probably underperform within the next coming years. It's almost impossible for an investment that has yielded modest returns historically, say for the past 15 years, to all of a sudden become a serious moneymaker. 10. Investment costs matter. All costs matter. Even that 1% fee could often go unnoticed. Many people don't pay attention to the small fees they're charged as they should. See, a small 1% fee may not mean much, but when you do the math, you'll be completely surprised just how much you could potentially lose. Let's say you're shopping around for a fund manager and you find 2 great choices. One charges you 1.5% annual management fees, and the other charges 0.5%. It doesn't seem like a big difference, does it? Right now it may not look like much, but over time that small fee could result in you potentially losing thousands of dollars in the years to come. It's believed that fund companies that charge more in fees have more money for research, and the perception is they do a better job. However, research indicates otherwise. Investors who minimize all their costs do better overall. 9. Have a margin of safety. Price and value for your money will always matter when it comes to investing. One of the best principles of the art is to have a margin of safety. By this I mean purchase assets for less than their real value. Basically, buy them cheap. Sometimes assets will be priced lower than their intrinsic values, especially during a recession period. Acquiring an asset at a low price or at below market price is a great deal for an investor because the return on investment is almost guaranteed. Plus, if for some reason he needs to get rid of the asset quickly, then the margin of safety will protect the investor. We all know circumstances can easily change in the financial markets. Financial markets are sensitive to multiple factors. See what happened with coronavirus. Within no time, markets are plummeting all over the world. 8. Asset allocation is key. The way an investor divides their portfolio among different asset categories is key to ensuring returns on their investment. This is where many investors fail, as they put very little thought into their asset allocation strategies. By investing solely in overvalued assets, you are bound to experience lower long-term returns. The key is to always evaluate all categories, underweight the expensive categories, and overweight those that are bargain priced. 7. Have a long-term mindset. Sure, you can make a couple bucks through speculative moves in the financial markets, but most of the time you'll burn a lot of money trying to chase the next big wave. The true essence and beauty of trading is buying an asset at a favorable price and waiting for it to appreciate in value. This may take a while though. As Warren Buffett says, long-term investing is one of the most important investing principles, as short-term trading will only lead to lower returns or losses in the long run. Don't let fear or greed take over your decision-making process and let time do its thing. 6. Power of compounding. If you're looking for exponential growth, then you better take some time to understand compounding. Take the time to understand how it works and how you can use it to double up your returns. One of the most exciting aspects of compounding is the multiplying effect it has on your money over time. Instead of constantly withdrawing dividends, leave the money there and watch just how much more you'll be able to make. As much as compounding may be great, it can also be detrimental. Reverse compounding can be devastating. For example, a 10% loss may only require an 11% gain to return to normalcy, but a 50% loss may require a 100% gain to get back to break even. Yikes! 5. Risk management. Nothing worthwhile in life comes without its fair share of risks, and investing is no exception. To minimize risk, investors employ risk management strategies. Volatility in one's portfolio is one of the leading killers that can wipe away your money in a flash. It's a serious problem, one that investors are constantly trying to maneuver around, especially in bear markets. For those who don't know, bear markets are the markets where share prices are falling, which encourages selling. So, by managing the risk, you will ensure you don't lose your money. 4. Volatility. You need to run from portfolio volatility, but embrace market volatility with open arms. It is easy to control portfolio volatility, but impossible to control that of the financial markets. However, with market volatility comes great opportunities. Be ready to take advantage of them at the right time. Be cognizant of the overvalued assets, and also be flexible enough to move your money once the conditions are not favorable. 3. Control your destiny. You should be in charge of your money because no one will care about your finances as much as you do. Conflicts of interest, fraud, and absurd fees make self-investing a very attractive option. Luckily, today, technology and the internet has helped in bringing down fees and all other transaction costs. It also provides all the needed information to make the right investment choices. There has never been a better time in history than now, where you can be a self-directed investor with very minimal effort. Instead of focusing on getting a fund manager or a financial expert, see what you can do by yourself. You will be surprised at how much you can save in fees and transaction costs. 2. Don't take it personal. Now, just like everything in life, you'll lose and win. The thing with investing is, you could either end up making minimal profits, make a ton of money, or lose it all. The markets determine the return rates, and they could either favor you or not favor you. Ensure you don't take any failure to heart, and be strong-willed to continuously invest your money. Never give up. 1. Continuously learn and research. There's a lot of information on the internet. Use this info to learn new trends, identify new opportunities, and channels of investing your money. Most of the resources are free, and some have a small fee. Continuously watch business news to understand what is happening, and you will soon become an expert investor all by your own accord. So in summary, 1. Continuously learn. 2. Don't take it personal. 3. Control your destiny. 4. Watch out for volatility. 5. Mitigate risk. 6. Use compounding interest to your advantage. 7. Have a long-term mindset. 8. Asset allocation is key. 9. Have a margin of safety. 10. Investment costs matter. 11. Regression to mean is the thing. 12. Diversification is paramount. 13. Risk and return go hand in hand. That's it for today, folks. We hope you learned a thing or two. Thank you for watching through the whole video. If you like the content, please give us a thumbs up, share, and subscribe. And as always, I'll see you in the next one. Have a great day.